so you can focus on what matters most to you. That's Africanacity. That's Absa.
So, this is where it all began. Those styles weren't working.
And we realized we could change that. So we made something of our own, something better.
And you didn't stop there.
We knew we weren't changing the world with our clothes, but the women who wear them might.
And that's how you went from playing with dolls
To becoming a fashion powerhouse.
We see you great. Katukuyambe Okusesamu with Absa Business Banking. Speak to us about how we can help you get it done. That's Africanacity. That's Absa.
Remember when the only person who worked for you was you?
Yep. My family was growing. I worked 16-hour days to put food on the table.
You needed to do something different that would help you stand out, and it made all the difference.
I could barely keep my shelves stocked.
You started this business to feed your family.
Now it's the family business.
We see you great. Katukuyambe Okusesamu with Absa Business Banking. Speak to us about how we can help you get it done. That's Africanacity. That's Absa.
From your docks to the rest of the world, speak to us for all your international trade finance needs. Mitigate risk and improve liquidity for seamless trade with our trade management online platform. The bravery to imagine. That's Africanacity. Absa Corporate and Investment Banking.
Get insurance from Absa. We will insure almost anything, so you can focus on what matters most to you. That's Africanacity. That's Absa.
So, this is where it all began. Those styles weren't working.
And we realized we could change that. So we made something of our own, something better.
And you didn't stop there.
We knew we weren't changing the world with our clothes, but the women who wear them might.
And that's how you went from playing with dolls
To becoming a fashion powerhouse.
We see you great. Katukuyambe Okusesamu with Absa Business Banking. Speak to us about how we can help you get it done. That's Africanacity. That's Absa.
Remember when the only person who worked for you was you?
Yep. My family was growing. I worked 16-hour days to put food on the table.
You needed to do something different that would help you stand out, and it made all the difference.
I could barely keep my shelves stocked.
You started this business to feed your family.
Now it's the family business.
We see you great. Katukuyambe Okusesamu with Absa Business Banking. Speak to us about how we can help you get it done. That's Africanacity. That's Absa.
From your docks to the rest of the world, speak to us for all your international trade finance needs. Mitigate risk and improve liquidity for seamless trade with our trade management online platform. The bravery to imagine. That's Africanacity. Absa Corporate and Investment Banking.
From the moment I met you, I made a promise to
insurance from Absa, we will insure almost anything so you can focus on what matters most to you. That's Africanacity. That's Absa.
So, this is where it all began. Those styles weren't working.
And we realized we could change that. So we made something of our own. Something better.
And you didn't stop there.
We knew we were changing the world with our clothes, but the women who wear them might.
And that's how you went from playing with dolls
To becoming a fashion powerhouse.
We see you're great. Katukuyambe ukusesamu with Absa Business Banking. Speak to us about how we can help you get it done. That's Africanacity. That's Absa.
Remember when the only person who worked for you was you?
Yep. My family was growing. I worked 16-hour days to put food on the table.
You needed to do something different that would help you stand out, and it made all the difference.
I could barely keep my shelves stocked.
You started this business to feed your family.
Now it's the family business.
We see you're great. Katukuyambe ukusesamu with Absa Business Banking. Speak to us about how we can help you get it done. That's Africanacity. That's Absa.
From your docks to the rest of the world, speak to us for all your international trade finance needs. Mitigate risk and improve liquidity for seamless trade with our trade management online platform. The bravery to imagine. That's Africanacity. Absa Corporate and Investment Banking.
From the moment I met you, I made a promise to stay true to you. This is true, only you. Because you are the only thing that matters in my world today. And when you're feeling down, I will be around to hold your hand. I'll help you stand. This is true. Because you are the only thing that matters in my world today.
Get insurance from Absa. We will insure almost anything so you can focus on what matters most to you. That's Africanacity. That's Absa.
So, this is where it all began. Those styles weren't working.
And we realized we could change that. So we made something of our own. Something better.
And you didn't stop there.
We knew we weren't changing the world with our clothes, but the women who wear them might.
And that's how you went from playing with dolls
To becoming a fashion powerhouse.
We see you're great. Katukuyambe ukusesamu with Absa Business Banking. Speak to us about how we can help you get it done. That's Africanacity. That's Absa.
Remember when the only person who worked for you was you?
Yep. My family was growing. I worked 16-hour days to put food on the table.
You needed to do something different that would help you stand out, and it made all the difference.
I could barely keep my shelves stocked.
You started this business to feed your family.
Now it's the family business.
We see you're great. Katukuyambe ukusesamu with Absa Business Banking. Speak to us about how we can help you get it done. That's Africanacity. That's Absa.
From your docks to the rest of the world, speak to us for all your international trade finance needs. Mitigate risk and improve liquidity for seamless trade with our trade management online platform. The bravery to imagine. That's Africanacity. Absa Corporate and Investment Banking.
From the moment
assurance from Absa, we will ensure almost anything so you can focus on what matters most to you. That's Africanacity. That's Absa.
So, this is where it all began.
Morning, ladies and gentlemen. Really, you can do better than that. Good morning, ladies and gentlemen. Great. It's a good day today. We're very excited to be here. My name is Helen Basuta Nangonzi, and I'm the Marketing and Customer Experience Director at Absa. Today is a great day. We get to announce our 2022 financial results for Absa Uganda Limited. Without preempting anything, you can see from my demeanor that they must be very good results. All right, before we get started, I would like to thank the members of the Fourth Estate that are here. Thank you so much for joining us. I would like to welcome the management and the board for Absa. Thank you for being here. Our online audiences, thank you for tuning in. So we shall get started. Before we do, allow me to introduce the members of the management team that are present here today. I'll start with this table. Just because they're eating, I just want to make sure. Okay, we'll start off with Albert. Albert Biarhanga is our Business Banking Director. Albert, you can stand up for recognition. You can clap for him. Next to Albert, we have Herbert Olo, who is our Head of IT and Operations. And then we have Dixon Agaba, who is our Internal Auditor. Next to him, we have David Kahwa. David is our Head of Compliance. Then we have Musa Jallo. Musa is our Retail Banking Director. And then we have Sylvia Mulomi, who is our People Function Director. I'll move to the table behind Mumba's table. We have Guy Lukwago. Guy is our Chief Risk Officer. Lutaya. I guess in my mind you should be mayor. Guy Lutaya, Chief Risk Officer. And then we have Peter Thaddeus. Peter is our Head of Treasury. And then we have Jomo Mutekanga. Jomo is our Acting Credit Director. We have the finance team. Let them stand up. Emmanuel, Lillian, they've done an amazing job in making sure that they put together the presentation, the numbers that you're going to see today, a lot of back and forth to make sure that everything we present today is accurate. Well done, Tim. And then to the main table, I'll start with David Wandera. He's our Head of Financial Markets and also Executive Director. And then to the three people who are the reason we're here today, I'll invite them to come and take their seats, these two. So Mumba, please come and take your seat. And Michael, Mumba is our CEO, that you know. Michael is our CFO and Executive Director. Come and take the hot seats. And then I'll invite our chair. Our chair is Nadine. Nadine, please come and make your remarks. You're welcome.
Hey, that light, eh? That light, it's okay?
Members of the board present, members of the Absa Uganda country management team present, members of the press, our audience online, and ladies and gentlemen, good morning. Thank you for joining us today as we deliver and discuss the financial performance of Absa Uganda Limited in the year ended December 2022, and progress we have made on our strategic deliverables. In 2021, we looked forward and planned 2022 with a high degree of optimism as COVID-induced lockdown approached its end. The reopening of the economy in January 2022 would signal the release of critical sectors that are key to driving business growth throughout the economy. However, lacking in the shadows was a crisis in Ukraine. You're all aware of that. And the spillover effect that would affect the global business environment. In Uganda, this would translate into high energy prices, the rising commodity prices, which led to higher cost of living, and that put a considerable strain on both individuals and businesses. Despite this, the bank remained steadfast, having strengthened our ability to operate in a constantly evolving environment. Both the local, regional, and global environment in which we operate. And we leveraged this strength to make a positive difference in the lives of our customers, colleagues, and the nation of Uganda as a whole. As we embarked on this journey, the board maintained its role of providing governance and strategic oversight to ensure that the bank fulfilled its objectives while remaining financially sound and delivering value for all our stakeholders. As both Mumba and Michael will divulge during this engagement, and that's the reason they're sitting there, we delivered strong financial results, remaining profitable and growing our balance sheet while continuing to meet our customer needs. This is a feat for which we are collectively very proud of. Beyond the numbers, we also stayed true to our commitment to being an active force for good in the communities within which we operate, focusing on 4 areas: the education skills, development, inclusive financing, promoting a just society, and environment sustainability under the guidance of our holistic environment, social, and governance ambitions. The social investment initiatives driven under our citizenship agenda saw the bank continue to contribute to disaster relief through the Uganda Red Cross Society to provide temporary shelter and basic household essentials to families displaced by flash floods in eastern Uganda. We made progress in inclusive financing through strategic collaborations with partners to support increased uptake of insurance, increase the possibility of land and home ownership by making credit to this purchase more accessible, and further still, provide accelerated access to credit for SMEs to enable business growth. At Absa, our people are truly our strength. Thus, the board is pleased to see continuous improvement to the employee value proposition, which has put the bank at the forefront of attracting top talent. Absa Uganda is proud to champion equity and inclusion for a diverse workforce, and it gives me great pleasure to report that 58% of our employees are women, of which 40% are in managerial positions. We commit to continue creating an environment that fosters growth and development for everyone. Looking to the future, as part of Absa Group, we recently refreshed our purpose to empowering Africa's tomorrow together, one story at a time. And ladies and gentlemen, this purpose is going to define who we are and how we operate in our business going forward. Through this purpose, we are looking to identify and pursue more opportunities to impact even more customers and sectors of the economy, while deepening our engagement with existing customers to understand how best we can help them achieve their goals and ambitions, and then provide the support needed to nurture them to fruition. We shall do this by continuing to provide bespoke product offerings and business advisory services that meet varying needs of our customers, while leveraging technology as a key enabler for convenience and cost efficiency. Additionally, we are also looking to have an even deeper and more positive impact on the wider society and environment within which we operate. This we shall do, among other things, planting 1 million trees across Uganda between 2023 and 2025 as part of our environment sustainability pillar. You're not clapping for that great environment ambition. On behalf of Absa Bank Uganda, I'd like to reiterate our commitment to harness Uganda's tremendous potential to contribute to the nation's socio-economic growth and development in line with the government's national development plans. As I conclude, allow me to appreciate the board and management and all the staff under the stewardship of Mr. Mumba Kalifungwa, our managing director, for their tremendous effort towards the bank's performance in 2022. And to you, our customers, we thank you for coming to choose Absa as your banking partner. We do not take the trust you have in us lightly and commit to constantly pushing the envelope towards becoming even more reliable and supportive of your growth of your business, of your ambitions. And to all our guests in various capacities, thank you for honoring our invitation and being present today. Thank you very much.
Another round of applause for the chair. I think some of the commitments the chair has made require another round of applause. We're committing to plant 1 million trees as part of our commitment to not only improving climate change, we're looking at ESG in its entirety. So I think that's one thing we could clap for. She has also talked about our commitment to be a force for good, the work that has been done for our people. We as staff, we're very happy, so we're grateful to the board and management for all the initiatives that have come through. So thank you very much, Nadine. Thank you for setting the pace. We'll now hear from CEO Mumba.
Thank you, Director of Programs, and thank you to the chairperson for setting the scene of this morning's deliberations. To the chairperson of the Board of Directors, Madam Nadine Biarugaba, members of the board present either physically or online, my dear colleagues from the Country Management Committee, my colleagues from the Absa Uganda family present, of course acknowledging the finance team for the hard work that has been put together in making this event possible today, and not forgetting the customer experience team that is responsible for this lovely environment that we have here today. Importantly, our partners from the Fourth Estate, members of the press, we welcome you and greet you this morning as well. Our online audience, must I say, distinguished ladies and gentlemen, I say good morning to all of you, and as we say in Uganda, mwasuze mutia. Thank you for making time to join us today as we recap on the year 2022 around our performance as Absa Bank Uganda. For many of us, as our chair alluded to in her remarks, 2022 seemed like we had been like a year that we had been hoping for. We all assumed we were going to put the pandemic behind us and find some sort of return to normalcy. Unfortunately, if the past 2 to 3 years have taught us anything, it is that we must be highly adaptable to volatility and uncertainty. As I like to say, uncertainty nowadays is a certainty. According to data from the Ministry of Finance, the Ugandan economy grew by 4.7% during the year 2022, while both the Purchasing Managers Index and Business Tendency Index remained above the 50% mark. This was a signal of optimism and improvement in economic conditions. On the supply side, services and industry were the main drivers of economic growth. There was also a strong recovery in wholesale and retail trade, real estate and education, with industry rebounding through construction. On the demand side, private sector investment and private consumption headed towards the pre-COVID levels. The current account deficit widened to over 9% of GDP, primarily reflecting a deterioration in the terms of trade and the wider trade deficit. In the financial markets, the 2022 Absa Financial Markets Index, which we presented at the beginning of 2023, indicated that Uganda's overall score from a financial markets perspective across over 20 competitors around market transparency, tax and regulatory environment, largely due to an improvement in factors such as ESG initiatives and standards after the central bank launched its strategic plan from 2022 to 2027, which focus on sustainability of the financial system and climate risk. Legal standards and enforceability was another aspect that led to the growth or strengthening of the Uganda financial markets, due partly to the existence of legal provisions for the enforceability of collateral and netting off. Uganda also recently partnered both with the European Union and Front Clear Management to support interbank transactions and further use of standard master agreements, which would bolster its score. Access to foreign exchange remains another pillar where Uganda scored very strongly. Uganda's score increased mainly due to an improvement in foreign exchange and interbank liquidity, and the score for FX reserves adequately also rose. Unfortunately, overall, we were also faced with increased inflationary pressures as a result of the higher energy prices, which slowed down growth in real consumption, reduced purchasing power, and limited credit growth as a result of reduced credit demand for a larger part of 2022. However, despite feeling all these effects, as Absa Uganda, we were powered by a drive to bring possibilities to life. We remained steadfast in our commitment to support our customers, even through these tough times. As a firm believer in the share value philosophy, our financial performance is not just a reflection of growth at Absa, but growth of our customers and all those within our value chain. Speaking briefly around the financial performance, I am pleased to report that 2022 was a year of growth for Absa across key parameters, which I will elaborate further below. I will provide a high-level overview of our financial performance and then allow for my colleague Michael, our CFO and Executive Director, to take you through the detail that explains the stellar performance that we delivered for 2022. Normally when there is a positive, there should be acknowledgement. Thank you. Our revenue grew by 12.5%, translating to 46 billion Ugandan shillings, which was a growth obviously on the previous year and made us realize revenues above the pre-COVID levels. This was driven by sustained customer and business recovery to near pre-COVID levels, as I indicated. But I think the correct messaging there is that we did recover to pre-COVID levels, because this is the second year in a row where we are delivering a triple-digit profitability. As mentioned by our board chair, we remain profitable as a bank, closing the year with a profit after tax of 141 billion Ugandan shillings. This reflects a growth of 28.9% from the previous year and delivering a positive return for our shareholders. This leap in profitability anchors our position as a leading banking partner in the Ugandan banking sector. We are pleased to also report a significant drop in our impairments by 94% relative to the previous year. This is owing to an improvement in the construct of our loan book and a continued focus in business support and recoveries to any of our distressed clients. The achievement is one of which we are collectively proud of, because it reflects our efforts to help customers regain and improve their ability to meet their credit obligations. Through sustained customer engagement, providing the necessary business and financial advisory, we were able to support our customers' businesses, most of which were in distress, to recover from the lockdown impact. Our net customer loans grew by 19.8% year-on-year, signaling a good and strong recovery from the year 2020 and 2021. As a result of our commitment to meet our customer credit needs, we continued to focus on providing support to our individual, SME, and commercial customers in their personal and business endeavors. As we unpack our business performance, striving to be our customers' primary banking partner remains critical to us. Despite our economy showing great resilience in the face of a global economic downturn, financial conditions continue to tighten significantly throughout the course of the year as high inflation and commodity prices eroded household and business incomes. Our focus through the year was therefore how to support our customers navigate through these tough times. We refreshed our business strategy and continue to adapt to more responsive customer needs, putting our customers at the center of everything that we do. I am pleased to report that our scorecard on our business performance reflects positive gains in efforts to optimize customer experience, drive greater efficiency in our processes, and provide a diverse and market-responsive solutions and products. I would like to appreciate our customers who continue to choose us as their banking partner. Furthermore, our balance sheet growth reflects return on our sustained investment in digital and alternate channels, in alignment with our strategy to improve our customer experience and enhance their digital experience. We believe in the power of digital delivery to provide seamless banking experience to our customers, meeting their needs at their convenience, and additionally, driving even greater efficiency in processes. While we have already realized significant progress, this will remain a priority for us as we seek to accelerate our digital transformation. As we continue to align our business strategy to the economy's growth trajectory, we supported the economy's growth trajectory by financing key sectors, including agriculture, trade, construction, real estate, and manufacturing. Our total lending to the agriculture sector stood at close to 200 billion in 2022, reflecting a growth of 40% in comparison to the prior year. Trade stood at around 300 billion, growing by 25% from the previous year, and manufacturing ended the year at just about 200 billion, growing 14% from the previous year. Overall, we had or realized an overall increase in our total equity by 12%, which denotes our ability to finance economic expansion across all strategic sectors of the economy. We are very well capitalized as an institution. Our financials are stable, and as you will hear later on when Michael provides the detail, very sound and poised for growth in 2023. Part of our key assets as an institution is our people. A winning, talented, and diverse team remains critical and pivotal to the success of our strategy. Our people are our strength and drive our competitive advantage, enabling us to better serve and show up for our customers on a daily basis. Our business strategy is to invest in the growth of our people as a key enabler for business growth. Over the past years, we've embarked on a deliberate effort to strengthen our employee value proposition by ensuring we attract and retain top talent in the market, supported by various internal colleague initiatives and programs. Our matrices reflect that our efforts are paying off, as indicated by the growth in our overall employee net promoter score as we build a workplace that people can continue to thrive and grow in. We didn't put the matrix there, but from a group perspective, I'm proud to announce that last year, Absa Bank Uganda was the most engaged team across the entire Absa group. I think my boss won't slap my hand for saying that, right? It's a statement of fact. Our matrices reflect that our efforts are paying off, as I indicated, and we also continue to make progress in the overall employee well-being. Among some of the accolades that we are proud to celebrate today is that most recently, Absa Bank Uganda was recognized as having the best practices in workplace, culture, and environment in the recently released Prudential HR Survey for 2022. So there is another data point. Some of the factors that led to this recognition are 86% staff retention for 2022, 92% retention of our top talent, 60% colleagues enabled to work from home, a policy that has also promoted the green community, thus reducing carbon emissions. As part of our shared value principle, being an active force for good in the economies that we operate in remains critical to the existence of Absa Uganda and the entire group. As a bank, we are cognizant of the large array of social challenges facing us, including economic development, job creation, quality education, and impact of climate change. Our commitment to being a force for good and sustainability journey that we have embarked on is driven by the philosophy to create a shared value in the communities in which we operate. By conserving natural resources and driving diversity, financial inclusion, education and skills development, and enterprise development, the bank contributes to the societies and natural environment in which it operates. We continued to contribute to skilling the youth through our Ready to Work program, which provides training courses that cover essential work skills, entrepreneurial skills, money, and people skills. This program increases youth employability and supports job creation. And most important of all, it's absolutely free. All you have to do is log on to the Absa Uganda website and look for the Ready to Work program. So it's a program that is tailored at fresh graduates, high school graduates, university entrants, and university graduates. Through various strategic partnerships, we supported SME growth, leveraging our pool of resources to provide viable businesses with support they require to grow sustainability. A few examples of where we participated are number one, 5,814 external beneficiaries that benefited from our skills and development programs. Ready to work being one of them, and financial literacy. We also supported projects that led to 30% reduction in waste generation, segregation at source to allow for reuse, recycling, and landfill options, as well as digital migration of most operations, leading to reduction in paper waste generation. Over 142 billion Ugandan shillings was extended to support local content initiatives in the country in the areas of waste management, construction, and transportation. Equally, we contributed a total of 90 billion Uganda shillings to the local treasury. To help increase the uptake of insurance in Uganda, we partnered with Prudential Uganda to launch the Absa Family Protection Plan, a life insurance policy designated to help or designed to help families plan for the financial needs faced during the loss of loved ones. Amongst other activities in the environment or communities in which we operate is a donation to the Red Cross Society in response to the flood that happened in eastern Uganda last year. Equally, through the Absa Women's Network Forum, our colleagues embarked on a journey to skill over 500 teenage mothers and women from the Central, West Nile, and Aberdeen regions of the country in financial literacy and personal development skills for employment and business creation. The ladies also handed over 20 laptops to the Wakisa Ministries and Terewode to enable beneficiaries at the centers sign up for and benefit from the bank's Ready to Work program. These, ladies and gentlemen, are just some of the initiatives that we embarked on in 2022 as part of our shared value and giving back to the communities in which we operate. At this juncture, I would like to thank you for your attention thus far and invite my colleague Michael to come and give some further detail of these stellar results that we will be presenting today. I thank you for your attention.
Thank you very much, Mumba, for that introduction. The board, members of management, members of staff, and the Fourth Estate, I'm very honored to present the results for 2022, another stellar year. So, Obugalo, before we start off, you know, it's quite exciting just talking about results coming back year on year. And we're talking about the partnership we have with our customers. So I'm very honored to be part of this. Apologies for the bad voice. I have a small cold that's coming through. So on to the results. As Mumba has alluded to, we delivered 12.5% growth in terms of revenue last year. And I want to encourage us to be participative because this is a collective effort for the staff. So Obugalo for the 12%. A big part of that was driven by the non-funded income. Non-funded income actually means that more of our customers are trusting us with their services. They're able to allow us transact more and do more banking services with us. And as a result, we did deliver the 15.6% growth. On the net interest income, we did deliver 11% growth. To give us perspective, that was fundamentally driven by the growth in the balance sheet that you will see. I think Mumba has already alluded to the fact that we had close to 20% growth on our net assets, but also the fact that we had pressure from interest rates. If you are following the news, we've seen close to 400 basis points increment in the US dollars. That actually means that the pressure on the margin comes through, and as well as the changes that we had in the central bank rate, that more or less squeeze out the margins that would come through. But I'm still happy to say that those were phenomenal results that we did deliver. From an expense perspective, I think to give us perspective around that is the fact that inflation has been more or less double digit for most of 2022. But happy to note that we did manage our costs carefully and delivered below 10% to 8.8% growth in our expenses. That called for quite a number of tactical initiatives to try and ensure that we manage our expenses. And that's also reflected in the cost-to-income ratio that has gone down from 58% last year to 56%. It's a reflection that we are more efficient as a bank and are serving our customers better. I think Mumba has alluded already to the fact that profitability, close to 30% growth year on year in 2022, both in terms of PAT and PBT terms. It's a good reflection to the fact that we have delivered to the treasury coffers as well, if you're to look at the PAT numbers that are coming through. In terms of return on equity, and that's a number that any shareholder would want to monitor, happy to note that it's 21%, double digit in the 20s, and that's clear reflection of the efficiencies that have come through as a result of our team effort to try and land the numbers. I think a lot has been talked about the assets. We did fund a lot of agriculture, a lot of trade, and for us that has been fundamental in a season like this one. And as a result, very good performance in that direction. When it comes to the liabilities, customer deposits, we did grow by slightly around 1.4%, and we had some strategic decisions around some expensive deposits that we had to make, and we are quite comfortable with the number that came through, but it's a real reflection of our continued commitment from our customers to ensure that they bank with us, especially when you're looking at the non-funded income performance. I think a lot has been talked about capital in terms of the banking sector. I'm happy to say that by the time the regulation came through, for those who don't know, we are required as banks to keep a capital number of 120 billion by the end of last year. Happy to note that for us, we're already complying with that effect. And as a result, our capital numbers continue to improve in that direction, which is a reflection of the efficiency and the profitability we're highlighting. I think Mumba has already alluded to the impairment. We have seen 94% reduction on impairment in a season like that one. I think that deserves a round of applause. Close to zero impairment in terms. And how did that come through? We had to have good conversations with our customers, and we're able to see very good opportunities and have some collections come through, and as a result, manage our non-performing portfolio that gave us those results. So that greatly affected our numbers, and as a result, you're seeing reduction in the total loan loss ratio. And we decided to share these numbers. We're coming from 2019 to give us a perspective, because a lot of us, I think COVID was a time where, you more or less write off 2 years of life. So it's important that we give you a perspective of how far we've come post the COVID period. And generally, we have seen revenues grow by close to 10%, 9.1% from 2019. Very good performance, fundamentally driven by the non-funded income, where we're seeing a good trajectory of growth, which is a reflection that customers are trusting us to transact more, to send money, in terms of bank assurance that was alluded to earlier. And that's a reflection of continuous utilization of all our services, especially when it comes to the digital aspects of things. The other part of the slide alludes to the cost management. As you're all aware, we've been talking about very high inflation ratios that we've been seeing in this industry. Happy to note that we've greatly managed our costs, and we are looking at about 6% on average that has come through over the years, which is a good reflection of what the teams have done to try and ensure that we still remain efficient in whatever we are doing. And you can see the growth trajectory in terms of profit after tax. 2020, a reflection of the impact of COVID, and the fact that we have more or less come out of the COVID season. And this is a true reflection of what we're also seeing in the business aspects, where we are seeing more customers come to us for credit, more customers are banking with us using our digital services, trying to manage our risk through risk management products. So that's a reflection of that performance. And I'm happy to say that in terms of a CAGR growth over the season, that has been about 22% in terms of profitability. We also wanted to highlight the return on equity, and this is all geared to give you a perspective that you have a strong bank before you, ready to see us through the seasons, especially as we work through Ukraine and the other so many things affecting the sub-Saharan continent. I think in terms of performance, we continue to see very good return on capital and well-managed cost in terms of the cost-to-income ratios that have dropped from 65% all the way down to 56%. I think that deserves a round of applause. Okay, I've talked about the loans and advances to customers. I think that has seen tremendous growth. The growth that you're seeing there is a reflection of what happened in COVID, the 5% growth. Clearly, you can see 2019, 2020, it's a reflection of the season where people were scared. A number of businesses were closed, but we are seeing the economy opening up, and as a result, starting to show the very good postings in terms of growth of what we are advancing to customers. The other side of the deposit is the fact that during COVID, people kept the money in the bank. They feared to invest. They were not going to China. And we have subsequently seen that capital start to move, picking up investment projects, doing transactions across the globe, and as a result, reflecting in terms of the base of our customer deposits. The loan loss portfolio, I think it's important that as we look at this slide, we remember the close to zero impairment numbers that we did reflect on. We're still managing quite a number of the non-performing balance sheet that we continue to work with. For those who are aware that during COVID, we had to more or less come up with specific payment terms for certain industries and handhold some of those sectors that were really affected by COVID. Subsequently, Ukraine comes in. We continue to work with our customers. And the beauty is that those ratios are slightly trickling down from a balance of about 235 billion in 2020, and that's slightly going down in 2022. I think I've talked a lot around the impairment. It's really a reflection of what is happening on the other side, and very good efforts by the collections teams, working with the customers, trying to ensure that we have the conversations early in advance to try and ensure that we land the numbers. But the most important thing, to try and ensure that we turn around the businesses, because it's in the interest that we see businesses turn around and continue to bank and continue to do business in this economy, that will see us work together as our purpose says. Yeah, I want to keep it at that. And thank you very much for the great results and for listening to me. Thank you very much.
Thank you very much, Michael. I think he has made us clap a lot. But before we go into Q&A, I would like to invite Mumba back just to give us the outlook for 2023, and then we'll open up the floor for questions. So for our online audiences, please go ahead, type in the questions. We have the team on standby to be able to get those, as well as the ones in the room. Mumba, you're welcome.
Thank you very much, Helen. Thank you, Michael, for those insights, which I hope provide a clear indication in terms of how that performance was delivered. I think as we conclude our presentation this morning, in terms of the outlook over the near and medium term, our projection is that economic growth will be supported by developments in the oil and gas sector and a rebound in agriculture output on improved weather conditions. We are already seeing a reduction in inflation over the first quarter, which signals better days ahead. We anticipate GDP to grow above the 5% threshold, as indicated by the central bank in their last policy statement as well, supported by declining inflation, appreciation of the shilling against the dollar, and continued economic recovery of businesses in both industry and services. Going into 2023, our strategic priorities remain centered around improving customer and digital experience, delivering and protecting returns, developing our people, and ensuring a sustainable control environment. Our focus is on executing against these priorities at pace, and we are making progress in each of them. The financial sector continues to become even more competitive with the constant evolution of the landscape within which we operate. We will define our value offering with a focus on delivering personalized experiences to our customers, taking the time to understand their needs, and through innovation, develop tailored banking solutions that match their growth ambitions. That notwithstanding, where we fall short of customer expectations, we will be candid enough to accept that and endeavor and commit to try and solution for you. Financial inclusion remains low in our markets, and we have taken it upon ourselves to become a more agile organization, serving customers beyond the realm of traditional banking. We continue to seek opportunities for collaboration to develop solutions that provide for last-mile banking. We are already well on our way to leveraging the power of strategic partnerships with various players, including fintechs, to give us the flexibility to make banking services more accessible to the underbanked population. We are driven by intention and purpose to be a force for good, embedding ESG as a priority within our strategy. We intend to continue making a difference in the areas of education and skills development, inclusive financing, promoting a just society, and environmental sustainability. We intend to put sustainability at the center of everything we do in order to deliver shared value within our community. It is in our DNA to connect our strategy with opportunities to drive growth and deliver shared value for our customers and communities. Ladies and gentlemen, once again, as I come to the end of this presentation, We thank you for your attention, your presence here today, and we look forward to deliberating further with any potential questions or clarifications that you may have. Thank you very much.
Let's recognize all our presenters just one final time before we go into the hot seat. Thank you so much to our board chair, Mrs. Nadine Biargaba. Give her another hand clap. Mumba, I think you're getting used to this, but either way, we'll give you another hand clap. Well done. Michael, we had no doubt. Thank you so much, and well done. We'll now open the floor to questions. We have, Juanita has the microphones. For the members of the Fourth Estate, it will be great if you can introduce yourself, and then you go ahead and ask the question. If there are no questions, we'll just take it that you're very happy. Going once. Martin, you never disappoint.
Thank you. My name is Martin Luther from Nation Media Group. Michael, let's go back to the NPLs. I was trying to write it down, and I hope I've written it well. In 2022, you had 195 billion, right? That translates to what percentage of the non-performing loan in the bank vis-a-vis the market, the industry rate? Then again, when I looked at the graph which was presented earlier, I saw agriculture taking something like 200 billion, I believe I wrote it well, which was about 40% growth. I felt disappointed a bit. I thought it would be more than that. Why is it slow, really? Because agriculture is a big sector in the economy. I feel it is small. It has grown, yes, but I feel it is small. Take my word anyway. And again, when I look at, was it trade? Trade, I think it was 300 billion, 25%. Well, it was a bit fair, but still, maybe we would do better. Then I was wondering, why is the personal loan and the household, it was taking most of your lending. Why? People are building, what are people doing really? Mr. Mumba, when you, in your outlook, I was looking at it very keenly, and some of the things that you raised was you anticipate growth in the what? In the oil and gas. I don't know how prepared you are to support this sector. I'm told there's a lot of investment there. So are you ready to maybe to give fundings in terms of loans to those who want to participate in the oil and gas sector? That is also what I've seen there. And again, you talked of closing the what? Closing the equity and credit losses ratio. You mentioned all those things. Do you think that still, how are you going to close them really? Are they going to become too small, or you're going to maintain them?
Thanks, Martin Luther. Since those have been very many questions, I think we can attend to them as the rest of the members think of more questions. We can start with you, Michael, commenting about the airline, and then we can end with Mumba, about the investments in oil.
Okay, thank you very much. I don't know if you can hear me. Okay, thank you. And Martin, thank you for the questions. I did anticipate one on NPLs. I think your question is really around how we fare vis-a-vis the industry. I don't have the specific numbers, but we're looking at about 10% which is the numbers, the graph that we showed, which is more or less in line with what the industry was experiencing. I think you need to look at the season carefully with the fact that we are coming out of COVID, which is subsequently followed by the whole war experience. So it's not the normal kind of season that you're seeing. But if you to go and assess the performance of banks, I think one you need to look at what's happening on their impairment lines. How are they progressing? Is it getting worse? Is it improving? Because we had one in 1,000 years kind of scenario, and we need to ensure that our businesses continue to work through. And that's why you've not seen those numbers strategically change, because of the credit measures we had to do. More importantly, seeing how businesses survive this season. But I am happy to say that if you're to look at the numbers, specifically running through the impairment P&L line, because that's a reflection of what's happening post the COVID situation. It's a clear reflection that we are improving and getting better. I think that's the key message I wanted to land there. On agriculture, yeah, we actually we would really love to actually lend more. But I think we need to also organize ourselves. Generally, if you look and you've traveled around the country, agriculture is subsistence-based. And it calls for us as a country, as a community, to organize ourselves to attract the kind of credit. But we have seen the commercial players, they are the ones driving a big chunk of this balance sheet. If you're able to organize a good chunk of land and engage in commercial farming, I think you get access to the banks. And I think for me, it's more of a challenge to us to organize ourselves better to ensure that we land. Because what we've also seen is your third question, which is around the personal loans. What's happening? You'll actually, because the security is the salary loan, and if you want to go and open up your 10 acres in the village, you come for a salary loan. And we'll book it as a personal loan. But you're actually doing agriculture in a sense. Or you open up a pig farm, whatever it is out there. So the point is, we need to organize ourselves better. But the personal loans that you are seeing are a reflection of the kind of security that, because it's secured by the salary, but it's not a necessary reflection of the activity behind the lending. So people are building, people are farming behind the salary loans. But I think we also did allude to the fact that we are giving out some of, we have unsecured loans in terms of business as a few banks, the only banks giving out such loans in this industry. I think that's it from my side. Thank you.
Yeah, thanks, Martin Luther. I think just in addition to the point that Michael spoke to around the personal loans, when you look at the graph that he was displaying there, that speaks to our loan exposures. That is showing the balance sheet position as at the end of the year. So we have a 1.6 trillion balance sheet in terms of loans and advances. Out of that, if you isolate the personal loans, that's accounting for about 24% of our entire balance sheet. So what that does tell you? That tells you that despite that standing out as a significant individual aspect of our lending, if you look at the wholesale business, which is your commercial businesses and corporate businesses, collectively, the bigger part of our loan book is to corporate clients, SMEs, and commercial clients. So just that clarification on that particular point, Martin Luther. And I think relatively, if you look at the growth in lending, we have grown our loans and advances by close to 300 billion in real terms, or is it absolute terms, as they say, is about 260 billion on a year-on-year basis. Out of that, 50 billion was advanced to personal loans. The majority is to corporate entities, SMEs, and commercial clients. You asked a question around oil and gas. Are we ready to lend in that particular sector? So our focus as an institution is around the ecosystem, or what we are calling enterprise or value chain. That is our area of focus. And yes, to that extent, we are ready. And one of the things that we did do, if you recall in my statement, I said we are committed to sustainability. The over 100 billion plus facilities that we offered around sustainability, around protecting the environment, are actually to entities within the oil and gas sector ecosystem. So I hope that provides you with context. Directionally, you are asking to say loan loss rates. Where do we anticipate them to be? Obviously, as you grow, the level of appetite from a risk perspective should increase. If you look at the loan loss rate for 2022, it was below 1%. We are projecting that we should operate within a region or a tolerance level of 80 basis points to 130 basis points. So put differently, 0.8% to 1.3%. And that is in tandem with the growth in our overall balance sheet. So as the risk appetite or as the lending increases, the risk appetite in terms of the tolerance limits for loan loss rates also increases. So that you should take in a positive sense. We want to extend further credit in order to be able to grow our returns from a top-line perspective and a profitability perspective. So the trajectory is positive and forward momentum going forward.
Thank you very much, Mumba and Michael. We have two questions that have come through online. One is they're both from Ali Twaha. He works with the New Vision. The first one goes to you, Mumba. Thanks for the presentation. In terms of outlook, Mumba, do you feel our fiscal operations will enable the kind of growth you project? And then to Michael, why is Absa not actively participating in the SBRF arrangement? That is the Small Business Recovery Fund. We can take any more questions in the room.
Thank you very much. My name is Kabona Esiara. I'm a journalist for the East African. There are some policy measures that the finance ministry is taking. Specifically, they have told us that they will reduce their appetite on borrowing on the local market. When you look at the biggest borrowers, or rather lenders of to the government, have been these commercial banks, social security funds. I wanted the MD to measure for me the impact of government reducing its borrowing appetite on your financials going forward.
Okay, we can take those three. So over to you, Mumba first, and then Michael.
Okay, so I think the first, the question around Small Business Recovery Fund, Albert Biaranga will take that, our Business Banking Director. The question from my colleague from the New Vision, some of the fiscal operations, are they poised to ensure that we stimulate growth? My answer to that would be yes, because part of the actions that you need to take is to be, they call it fiscal consolidation. You want to be more prudent in your expenditure so that you focus on expenditure that is going to generate value. So those measures of fiscal consolidation, yes, I totally subscribe myself to those. They are relevant. You've talked about policy measures such as borrowing, domestic borrowing from the local market, looking for cheaper sources of funds. It is the right thing to do from a debt sustainability perspective, because what you are trying to work at as a nation is to say, how do we ensure that we rebalance our financial commitments in terms of what we pay out from a debt perspective? So at a national level, it is the right thing to do to manage your borrowing cost relative to the revenues that you generate. What does it do to commercial banks? Normally, there is a concept called crowding out. When the central government is borrowing more from the market, it therefore means there is a tendency to prefer risk-free investments, as it were. So for me, I would say it's a good problem. It's a good problem in the sense that it provides more liquidity for onward lending to the local domestic market. So it provides an opportunity to stimulate private sector credit growth. And if all the intentions or plans work accordingly, you should expect to see that as we go into 2024, if the measures that have been instituted to manage inflation, to manage interest rates, ideally what you would expect is as government takes that stance of borrowing less domestically, there will be more liquidity for onward lending to the private sector. I think that would be my comment around that. David Wandera, Director of Financial Markets, is around. He can also add some further context to that to provide a more detailed view. So David, happy for you to comment on that before Albert addresses the comment around the Small Business Recovery Fund.
Mumba, you are spot on in your response. As government seeks to move away from the domestic financial markets, the impact would be that interest rates would reduce, and that means more commercial bank lending will move to preferably business lenders. And also with the focus that government has investing in infrastructure and areas of the economy that are facilitating growth, it means that all those actions together will result in better economic conditions for businesses to prosper, coupled with what we are seeing, the growth in investment in oil and gas as expected, and we are beginning to see come through. All those factors will come together to grow or contribute towards the economic growing. Obviously, the headwinds of what's happening in the global financial markets, what's happening with logistics and supply chain across the world and how they're affecting things like steel and other commodities that are used in our manufacturing sector could negatively impact growth. But if government reduces borrowing from the domestic financial market and invests in the right sectors that it's targeting, we'll see bigger growth coming through. Thank you.
So my question was around whether or not Absa participates in the Small Business Recovery Fund. And the quick answer, I hope I got it right. Yeah? And the quick answer is yes. So Absa is a participating bank. I, however, just want to clarify like one or two things. Last month, the Central Bank of Uganda convened all the participating financial institutions to discuss the matters relating to the slow uptake of, under the Small Business Recovery Fund. And for those that might not be familiar with it, the Small Business Recovery Fund was an initiative, by government through Bank of Uganda to support small businesses, especially recover, those that were significantly affected by COVID, to shore them up and see how they recover. So Central Bank met the participating financial institutions last month to discuss the issues relating to why the uptake was low. And there are a couple of ideas that came through the banks to see how we can encourage both the beneficiaries and the banks to increase uptake. And one of them, if I may mention, the minimum, the maximum amount under the SBRF was 100 million, and there was a proposal that should be increased to 300 million shillings. The other was around collateral, and the initial guidelines suggested that the beneficiaries should provide collateral for them to be able to benefit. Now, part of that was relaxed, and I think about 20% of the amount can be accessed unsecured. So there are a couple of other things that were discussed, but just to emphasize that we should see a bigger uptake under the small business recovery. Let me also emphasize, though, that for Absa as a bank, We were able to receive applications from a couple of clients, and we actually came across some of the products that we offer to SMEs. They came across as very competitive, and they were able to benefit from most of those products that we're offering. And I want to single out what we offer as under unsecured lending for SMEs. We do offer up to 100 million shillings lending to SMEs. So most of those that were looking for relief, they were able to benefit from the kind of solutions that we're already putting out there in the market. So I hope that clarifies it, and it gives you the comfort that yes, we are supporting the businesses recovering through the effects of COVID. Thank you.
Thank you very much, Albert. Any more questions from the audience? Oh.
Albert concluded with something that uninsured, do they pay you? The things sound uninsured. Do they pay you or they just walk away with the money? Anyhow, let me go back to the question about the policy rate. I think from June to October last year, there was an increase of, that was about, I think, 350 basis points. So what I'm wondering, how has it really impacted on your credit in terms of, say, the lending rate and then the rate at which people are coming to borrow? Did it scare them away? And has this forced you also to raise it a little high to stay afloat in the market? And something which was, I went back again and I was wondering from the beginning, I looked at it, but it is like, it skipped my mind a bit. What was really the main driver of that growth of 140 billion, Mr. Mumba? What was really the main growth?
We might have a skeptic in Martin Luther. Any more questions? Okay, there is another one there. If Jonita, you can help me with the microphone.
Thank you again. My name is Agene Kabona. Everybody is worried about the Ukraine-Russia war. As a financial institution, how is Absa prepared to walk into this murky water? We don't know when it's ending, and of course, being a service industry, it must be impacting you somehow. How are you prepared, and what assurance do you give to the shareholders, and maybe even me, the smallest client?
Over to you, Mumba.
So I'll take the second question around Russia, Ukraine, then Michael will speak to the financials once again to provide clarity in terms of what drove growth. I think when the Russia-Ukraine war started in Q1 of 2022, obviously I think we were all alive to the fact that we saw an increase in energy prices. We saw supply chain disruptions in terms of increased costs of containers and transportation, increased costs of inputs for various importers of goods that are involved in the business of manufacturing. So that was almost a year and 2 months ago now. What did we see? What we saw is that all entities that were involved in manufacturing began to see the effects of that in terms of an increase in input costs, pressures on margins, and the like. What did we do as a bank? We had conversations with all our clients. It was about keeping close to them and providing the relevant financial advisory in terms of how they manage their finances in view of what was happening. Some of the experiences that we saw was that there was a lot of financial re-engineering, so to speak. Companies had to look at their cost base. Companies had to look at their efficiencies. They had to look at new ways of doing things to ensure they were able to cushion the impact of the increased cost as a as a consequence of supply chain disruptions. There was also an increase in cash flow management. I think part of the performance that you see is as a result of increased trade and working capital extensions to various companies that are involved in manufacturing and import of goods. So to your question, if you say how ready are we have been ready from last year. And we have policies and procedures in place that enable us to respond to changing circumstances from a client's business operations environment and also from an external environment in terms of things that are being beyond our control. So really, it's about having a discussion with the clients, understanding their business and how that reconciles with our objectives of ensuring, greater efficiency and returns on our shareholders. So I hope that provides you with some context. Will disruptions continue? I think as we went into the latter part of the year, and if you've seen what has happened in 2023, there's been a tapering down in terms of inflation. What are some of the key contributors? Reduced food prices, reduced fuel prices, which are key elements that drive up your inflation cost. So yes is the short answer to your question of how prepared are we and what are we doing to monitor the developments that are happening in the external environment. So we are well poised to respond to the challenges and have the relevant conversations with our customers.
Yeah, thank you very much, Mumba. I'll just make a small contribution to that. So Ukraine-Russia happened last year, and part of what we did was to ensure that there's a balance sheet to see our customers go through. For those who want to continue borrowing, that balance sheet is available. So providing that resilience and ensuring that we have the tools and having the conversations, as Mumba has alluded to ensure that we work with our customers. We've got risk management products that can help you manage interest rate risk, FX risk, such that you sail these turbulent waters. And as a bank, that's what we've been able to do. We're also working with our regional players. As you know, we're a regional bank. How best can we facilitate through our counterparts to reduce the cost of production? So those are some of the things we are doing to try and ensure that our customers sail through these turbulent times. On to the central bank rate. When you actually think about the increment, the 350 bips that you did talk about, the whole reason why the central bank increases interest rates is such that we pass it on. And that's the only way they can manage inflation. If we reduce the liquidity in the market, that subsequently we reduce the cost of goods. And how did it affect us? In certain aspects, you will pass it on. In others, there will be aspects of pressure on the margins. Because I don't think all the customers saw the increments in borrowing costs as a result of the CBR. So there are those that take on floating rates, and there are those that take on fixed rates. But in between there are aspects of pressure on the margins. So that's a bit that kind of works through our balance sheet. You did talk about the 140 billion. The first point, and I want to emphasize this, just pause and think through. Ukraine, no Ukraine, we are still lending. 20% growth. We decided to say, look, the economy is opening up. A lot has happened, and COVID is behind us. Let's lend. So there were those traders, there were those customers that started thinking seriously about investments. We went out and were able to facilitate those investments to them. Two, we had great conversations in terms of managing our non-performing portfolio. Coming close to zero impairment practically means that we're quite close to what was going on in our customer space and picking up any opportunities to recover money in that year. And to me, that's a good thing, which clearly helped us in our favor. But I also did allude to the efficiencies we talked about, improving cost to income ratio, and quite a number of things. So the efficiencies across the business greatly helped us, and as a result, delivering the 140 billion that you've talked to. Thank you.
Thanks, Michael. 141. It's 141 billion. All right. If there are no other questions, then we'll close the Q&A session. Allow me to thank you once again for joining us for this financial results release. I'm sure it's been fruitful. To the board and management, thank you so much for the support. To all the colleagues, thank you so much for everything that you do to make sure that we post these numbers. We are looking to an even stronger 2023. So thank you very much. I'll say goodbye to our online audiences. For the fourth estate that are still in the room, there'll be time for one-on-one interviews with either Mumba, Michael, or the chair. Thank you very much, and have a great day.
I made a promise to stay true to you. This is true, only you. Because you are the only thing that matters in my world today. And when you're feeling down, I will be around to hold your hand. I'll help you stand. This is true. Because you are the only thing that matters in my world today.
Get insurance from Absa. We will insure almost anything so you can focus on what matters most to you. That's Africanacity. That's Absa.
So,